Hey everyone, thanks for joining me for this one. Today we're going to be talking about Restaurant Brands International. And for those of you who don't know, this is the company that owns Burger King, Tim Hortons, Popeyes, Firehouse Subs, which they recently acquired. In this video, we're going to talk a bit about their growth strategy, how they are looking at the business, viewing the business, structuring the business, as well as how their recent results have been and how they've been doing on that growth strategy. So if you like this type of content, please like the video. Would really appreciate if you subscribe to the channel too. We're still a pretty small channel, so it would be great to grow our subscribers and our community as well. But without further ado, let's get into this one. So Restaurant Brands International is a company that trades on both the Canadian Stock Exchange as well as the New York Stock Exchange. And they're a quick service restaurant business, as you can tell. Their brands that they own are on the screen right now. So their biggest brand as a whole is Burger King. And Burger King is a business with almost 19,000 restaurants in over 100 markets worldwide. So this is their biggest global play in the company. Tim Hortons is another big business that they own. Over 5,000 restaurants, primarily in Canada, but they've been trying to dabble in global expansion there. Popeyes is one they acquired a number of years ago for about $4 billion, I think. And they've been really aggressively trying to grow this business through global expansion. And then Firehouse Subs is a very small tuck-in acquisition, 1,200 locations, just about 2 to 3% of the company right now. But they really love the product, and it'll be really interesting to see how they plan on scaling that business as well. And what I love about that acquisition is it's actually profitable from day one. They're currently cash flow and EBITDA positive, which you'll see in this video. So going into their value proposition a bit, and some of these slides are from different periods of time. So they're talking about three iconic brands, but they do own Firehouse Subs as well now. But just generally, they really focus on playing and building really strong brands, and that really propels their flywheel to go from playing with big brands into leveraging those brands for sustainable top line growth opportunities, which we'll talk about in the next slide, and then going into global growth. So how can we leverage and scale the businesses not just in North America but globally, using that scale to get efficiencies on technology investments, both internally and to the consumer externally through apps and stuff like that. And then, similar to this one here, continuing to scale the efficiency of the platform. And all of this adds value, which then creates more revenue and profit at the corporate level to invest more into the brands, to drive more top line growth, et cetera, which over time should hopefully create a lot of value for shareholders. So let's talk about a couple of the components of that value equation there. The first one was sustainable top line growth. So here's just some examples of things the company's focused on to make sure that top line keeps accelerating, which really fuels the rest of the model. Obviously, having quality and everyday value in their menu, in their food, is like really high importance. So you'll see a couple things here. Some iconic brands, the Whopper chicken sandwich at Popeyes. But then also from a value perspective, really focused on the dollar menu, on Tim Hortons being fresh and providing strong quality on breakfast through fresh brewing and freshly cracked eggs, they call out there. Really important for their business. And then staying fresh, staying new, staying relevant through innovation. You can kind of see some of the things there. Something that they've really invested in the last few years is digital. So you'll see really strong digital capabilities across all these players. And when you have a lot of different brands, a lot of different businesses, it makes making these digital investments pay out a lot easier, and gives you the ability to invest more into them, because they can use something that has worked on their Tim Hortons app and scale it across their other apps. And they can start integrating the backend platforms together, et cetera, et cetera. So it just makes it great to have a lot of scale, have a lot of different businesses in the same space when it comes to digital and making digital make sense. And then lastly, they're always focused on a strong guest experience. So they talk a lot about digital menu boards increasing the amount of drive-through lanes for speed, increasing the amount of window locations rather with drive-throughs. We won't get into that too much in this video, but they are focused on all of these elements in order to drive top line growth. Now, how have they been doing in terms of accelerating restaurant growth? So they kind of look here, different verbiage, but higher revenue per store, top line growth, but then also looking at how can we increase our restaurant growth in order to scale this across more businesses and ultimately have more profit centers around the world that are paying the corporate company royalties on a monthly basis and licensing fees. So you can kind of see here, and take this with a grain of salt because there are some acquisitions in here which you see get layered on, but them scaling the amount of restaurants they have globally, from 12,000 to 27,000 over the last 10, 11 years. This doesn't have the last couple years on it, but you can kind of see this is a good sign that in markets that they already exist in, they've been successful in expanding their restaurant count, and they have enough demand to support more restaurants in more areas, but also kind of shows, especially on Burger King, they've been pretty successful on bringing the brand global, with the exception of the last year there. It looks like it ticked down a bit, but generally speaking, it seems like they've been generally successful in growing restaurant growth. And when you're talking about a business like this, at the end of the day, when you're getting a slice of top line royalties, the higher the dollars per store and the amount of stores is, the higher the profitability of corporate's going to be. So obviously from that last slide, we looked at how they were looking at having higher revenues per store. This slide is just showing their record of delivering restaurant growth. And the combination of these two things, if done at the same time over a long period of time, will really compound earnings at a corporate level and EPS that you'll see flow through as a shareholder. I just want to touch quickly, because it was kind of like the hot news with the stock last year, was their acquisition of Firehouse subs. Firstly, what's great to know is they bought Firehouse subs, I believe it was about $1 billion or just over $1 billion. It's about 3%, 2 to 3% of their market cap at the time, fully in cash. So to see that they literally used all of their excess cash after paying the dividend of just royalties and licenses they got from operating Tim Hortons, Burger King, Popeyes, and they were able to buy a completely different brand and business that is already adding profit to the bottom line, is a great testament to see how cash flow strong this business is, and how great this business is from being relatively capex light and not really needing to invest in too many of their stores, because at least two of their three big brands, they don't really own many of the locations. They're strictly getting royalties, and we'll go into that in the next slide. But just an overview, because you are getting this business when you buy Restaurant Brands International stock. Firehouse Subs is essentially entirely franchised. Does $1 billion in system-wide sales to a franchisee buying a location. It takes 3 to 4 years to get your money back on average, based off of how the locations have been doing, and they've had pretty strong same-store sales growth over the last number of years. I think that slowed down last year, but overall, it seems like it's generating good traction with consumers and the market. And then in 2021, $50 million in adjusted EBITDA. I think we'll look on one of the next slides, but they're on pace for much more than that on an annual basis for 2022. Okay, so before getting into the numbers a bit more, just a little look at how they look at total shareholder return. So obviously, EPS growth plus strong dividend. They both have almost like an industry-leading dividend for top-tier QSR companies, but also looking at compounding EPS growth as well. And then in terms of how can we build shareholder return on top of that, they have been doing repurchases. They don't do it in a big way. They're not a huge repurchaser like Domino's, or they're not taking out tons of debt to repurchase shares, but they have been slightly repurchasing stock year over year. I think that slowed down a bit with the Firehouse Subs acquisition, but long term, it's part of their capital allocation model, so we should see it pick up again. and then strategic investments. So they talk about acquisitions, Firehouse subs, which we just talked about as an example, but also investing in how can we increase top line growth? How can we increase store count through either launching in new markets, which cost capital off the bat, or um, helping to incentivize store construction and bringing stores um, to like the modern age of restaurants. So they can make all kinds of decisions other than repurchases and dividends to return shareholder value long term by growing their revenue per stores in different ways and different investments. Okay, so taking a look at the stock today, it's ran up recently. We won't get into it, but this big jump here, I believe, was the ex CEO of Domino's, who did a tremendous job scaling that company and getting them to the point they are today globally. Is now the chairman of the board of Restaurant Brands International. The company jumped huge on that news over a couple days, like 10-15%, I believe. Um, I'm usually not a big fan of big stock moves on personnel changes unless it's someone like revolutionary at the helm. I don't know the restaurant space well enough to know if that's the case here, but I'd rather see some results before paying more for a company. But that's besides the point. The company is trading richer than it previously has been. But when we look at how the company's trading, it's going to do about $4.10 of EPS. So just doing some quick math, that's about 22 to 23 times earnings for this company. And this is a really defensive business. They own fast food chains, they own restaurant chains or morning restaurant chains, sub business chicken company. So they're a well diversified quick service restaurant company. And when we look at their competition, uh, sorry, this is just for those of you who are US investors and situated in the US. Just wanted to call out that they also have um, a US stock on the New York Stock Exchange too. So same valuation. I think this market cap's a bit off. They have about 450 million shares, so it's probably about 30 billion US, 40 billion Canadian. But you can also invest in this without dealing with currency headwinds and investing in a different country's exchange, and you do get about a 3.2, 3.3% dividend. But when you look at their competition, um, McDonald's, Yum, which we'll get into at the end of the video, but they trade at a premium to this company. So as we look through these numbers, let's try to look at if there's any justification, any reasoning for QSR to be trading at a significant discount to its peers. Okay, looking at revenue for Restaurant Brand International, you get a pretty interesting picture off the bat that I want to call out. You can see Tim Hortons is $1 billion of their last quarter revenue, despite total revenues being 1.7 billion. So Tim Hortons is over 50% of the company. And if you recall on the first slide, Burger King had almost 4 times as many locations as Tim Hortons. So what's good to know about this company is while Tim Hortons is not the biggest part of the company's footprint to a consumer, the business actually owns many of the Tim Hortons restaurants. So they have a lot more exposure to Tim Hortons than these other businesses where they just have franchise and royalty rights on top line sales. They actually own a lot of the Tim Hortons stores and locations, which makes the revenue for the Tim Hortons portion higher. But also the income on Tim Hortons it's not as high margin since it's also capex in there, but it's almost like 50% of this overall business, 40 to 50%. So keep that in mind when you're investing in this. You are getting the brands if you're in the US that you are familiar with, but the other side of the business is Tim Hortons, which is primarily a Canadian play. They're trying to expand it globally, but don't overlook that because lots of people just look at the big brands, assume Tim Hortons is a small part of it, especially if you live in the US. But just the way the ownership structure of these restaurants and locations are in place and who actually owns the businesses, Tim Hortons is definitely overexposed relative to the other businesses. Now, one day will they sell off those locations and turn it to strictly a franchising play similar to the other ones? Maybe, honestly, likely, or wouldn't be surprised at least based off how they talk about wanting a lean operating model. But that's not the case today. Anyways, You look at the growth rates. Um, Popeyes has been growing at a pretty fast clip for the last number of years, over 14% in the last quarter. BK is kind of what they've struggled with the most over the last 5 to 10 years, as McDonald's has just absolutely done tremendous in this category and in burgers and beef. But seeing some growth there. Tim Hortons, this is a bit of a misleading number because in Canada, lots of people still haven't been going into the office over the last couple of years, so it's a very low base. But we're getting closer to 2019 levels, so this business is still correcting back up to where it was prior to COVID as well. Lastly, Firehouse subs, you see here $38 million in revenue. So about 2.5% of the revenue on the quarter. You can see there was nothing year ago because they didn't own it in 2021. So it's a nice little revenue accelerator and hopefully future growth for the company. Last impact here is just this is in US dollars. And then based off of the global exposure of Burger King and then also the Canadian exposure of Tim Hortons, it's a $50 million hurt just from FX. So every US based company is experiencing something like this. But just worth noting, these numbers here, Tim Hortons is actually 20%, not 16 in constant currency. Burger King is actually 9%, not 5%. But at the end of the day, the company incurs costs in US dollars, reports in US dollars. So that's just how it goes. And sometimes you'll get the bad end of the stick, like here, where you have a 1 point hurt overall. Sometimes you'll get a better end of the stick, but just worth noting here. Now, just to go restaurant by restaurant, Tim Hortons here, you can see what I want to call out is really the comp sales. So this is taking out the net restaurant growth. How much are the same store sales going up? And it looks like at Tim Hortons, that's about 10%. It went up about 9% a year ago. I think it dropped somewhere in the 20s for 2019 to 2020. So we're almost back. We're almost back over the last 2 years to where this business was performing at a restaurant, like per restaurant level as pre-COVID. So hopefully as we get into 2023 with some of the growth initiatives, this business can kind of get past its old all-time highs in terms of performance and continue to do well. You can see here total revenues grown in line with total system-wide growth, but between net restaurant growth and comparable sales, the growth is really still coming from comparable sales. They've had a tougher time expanding Tim Hortons globally, even though it's a big initiative for them, just because it's a very Canadian nostalgic business. And lots of people are less aware, maybe don't care as much about the history of Tim Hortons outside of the country of Canada. Going into their most popular brand that they own the rights for the brand for are Burger King. So almost all Burger Kings, I believe, are owned by franchisees. So this company that you'd be buying the stock on owns the trademarks, owns the equity, how everything comes to life and what they have to do. But all the physical locations are just individual entrepreneurs or a group that owns a bunch of them in some areas of the country or the world. And then they pay a percentage of top line sales to Restaurant Brands International. So whether that's 3%, 4%, 5%, it really depends on the agreement and the country and how things are going. So despite being a business that has 4 times as many locations as Tim Hortons, the revenue for the quarter is half as much because they don't actually own any of the physical stores for the most part. You can see similar story as Tim's. They have about 10% comp sales growth, which is pretty strong, but then really weak net restaurant growth. So would need to look into that a bit more. If they open more, but then they had some shut down, that's usually the case. And if there's anything to be concerned about in terms of the growth prospects on a business like Burger King. But Burger King's a really, really important part of the business here, just because it's the most global. And even where they're expanding Tim Hortons, they're expanding Popeyes, Firehouse subs in the future. They're really leveraging their relationship with business people, governments, investors in other countries as they're expanding and launching these other brands in those markets because they're building trust and know-how behind the Burger King brand. So huge strategically important brand for the company, despite not being the highest revenue portion of their business. Going into their two smaller brands, which they've both acquired over the last 5 years. Popeyes, interestingly enough, was growing like 20% same store growth in the late 2010s. That's really slowed down the last few years. You can kind of see over the last 2 years they're flat. But I think their same store sales is healthy on an absolute level. So obviously want to see this grow, but I don't think this is dire here and now. Um, we'll see with inflation and other pressures on franchisees if that changes. But what is really exciting to see is the highest net restaurant growth out of any business that RBI Restaurant Brands International owns. So up 9% year over year. Before that, up 6%. So despite low to no sales growth over the last couple years, the system-wide sales has grown at a respectable pace, 5% and 12%. And then Firehouse subs. Won't spend too much time on this one, just because it's still such a small part of the business. But you can kind of see um, the tail end of their fast growth stage in 2021. They were growing 20, 25% compounded same store sales growth for a number of years. It went down to flat this year, but we are seeing some restaurant growth, which is good. I'm giving them a pass on this, giving RBI some time to figure out how they want to go to market, what they want to do with this business, and figure out the best way to scale it up. As long as they continue to be provide revenue and EBITDA profitable for the business, I'll give them some time on figuring out the best way to scale it. It was a pretty small tuck in the grand scheme of the company. So let's just take a look at that all together. Restaurant by brand, they own about 30,000 restaurants now in 2022 or beginning of 2023. You can kind of see, and when I say they own, they are stakeholders in. Lots of these are individual franchisees. You can kind of see 25,000 of those 30 are Tim Hortons and Burger King. So please do not invest in this company if your objective is, I really just love Popeyes or Firehouse subs. That is under 10% or about 10% of the company in terms of revenues is the bottom two. The other 90% is the top two. So you are investing in Tim Hortons and Burger King, and then you're kind of getting a flyer on Popeyes and Firehouse subs essentially when you're buying this business. In terms of restaurant growth, you're seeing good restaurant growth both in 2022, which is the left-hand side, and 2021, which is the right-hand side, or at least growth, maybe not great, but growth across the board, which is good. And, growing every restaurant in the third quarter of 22, and 21, that can really let you compound your restaurant growth over time, which is what you're seeing on this side here, going to 30,000. And their longer term, midterm projection or goal is to hit 40,000 restaurants. I think they're well on their way to that. Okay, so just looking at stock comparables, we talked about how Restaurant Brands International is about a 22 and a half price to earnings ratio right now. When we look at McDonald's, I'm an investor in McDonald's as well, and McDonald's is hoping to get about $10 of EPS this year, I believe. So that's about 26 times earnings. So you're paying about a 20% premium for the earnings and EPS of McDonald's, going from a 22 to a 26 than you are for Restaurant Brands International on the open market today. So McDonald's is a great business. They've been doing it forever. They've been growing market share. They're super globally diversified. They do have some real estate exposure as well. So I think it makes sense, and I understand why they may have a small premium. I think this is probably the higher end of the premium that I think is justified, especially given how diversified QSR is, and they probably have more opportunities to scale globally. They've showed early success of being able to do that in terms of restaurant growth. So based off of the valuation of McDonald's, and it could be true that the whole space is overvalued, fair, but on relative value, I think Restaurant Brands International is um, you know, in a good spot in terms of how they're valued, if not moderately undervalued today, because I do think that they do have um, things that McDonald's doesn't have, even in terms of the diversification, having a very clear chicken play, a very clear sub play, a very clear beef play, and then a morning play with Tim Hortons. Whereas McDonald's is trying to do it all at once with the same business, which they've been successful with. But I feel like uh, RBI is a bit more diversified. So you're getting probably better diversification, better global expansion upside. So, you know, to end the ramble, I think RBI's in a good spot in terms of valuation and in a better valuation spot relative to McDonald's at least. Looking at Yum, they also trade mid to high 20s. And when I compare these businesses, Yum owns KFC, so that's their big chicken play, Pizza Hut, so that's pizza, and then Taco Bell, obviously tacos. So I think these businesses are so similar. Obviously, the big difference is Yum Brands is more developed internationally, whereas RBI is more developed in Canada and the US. But I don't think international has, like, we should be paying a superior valuation for companies with international exposure versus North American exposure. If anything, North American exposure is less volatile. So I don't see why I would be paying more for Yum Brands than I would for RBI. And when I just benchmark against both Yum and McDonald's, I think RBI is positioned well or has some downside protection from a valuation standpoint, is I guess what I'm getting at. The other thing is you have about a 2% dividend on Yum, you have a 2.3% on McDonald's, and on RBI, which ticker is QSR, short for quick service restaurant, you're getting a 3.3-ish yield. So you're getting a better yield, you're getting a cheaper valuation, and you're getting, as long as it can execute well, better upside potential on location growth. So that's why I've been investing in QSR. It's not a huge position just because of the overall value still being over 20, and some of the risks in this space with like the consumer, but then also just on a valuation level. So it's a relatively small position for me. I think it's like a 2 to 3% position in my portfolio, but it's performed really well over the last year with everything else getting hit in broader market and tech. So it's at a spot where I'm not really buying more of it, but I like having it, and I collect that dividend and reinvest it in other opportunities. And it's a stock that I think you should consider looking into. With that being said, obviously not a financial advisor, and please do your own research before making any investment decisions. But I think this is a very interesting opportunity in the restaurant space and the quick service space, especially if you're looking for any exposure outside of the US, because you get the Tim Hortons exposure on Canada and you're getting a lot of Burger King exposure globally. And the global piece is where lots of the company is going to be focusing on extracting growth from in the coming years. So that's today's video. If you like this type of content, please subscribe to the channel. If you own this stock or other restaurant stocks, would love to hear about it in the comments, and I'll see you guys in the next one.